All right, welcome to the Explainer. Today we're going to decode one of the most fundamental, most important documents in all of business, the balance sheet. If you really want to understand a company's financial health, this is where you start, and we're going to break it all down.
So here's our game plan. We'll kick things off with the core concept, the big idea. Then we'll get into the golden rule that makes it all work. We'll explore both sides of the sheet, and finally, we'll talk about what the numbers don't tell you, which is sometimes the most interesting part. Okay, let's dive right in. And we're going to start with the single most important idea you need to get your head around when it comes to the balance sheet. It all comes down to one thing: time. And this is just the perfect way to put it. You see, some financial reports, like the income statement, they tell a story over a whole year. That's the movie. But a balance sheet? No, it's a snapshot. It freezes a company in a single moment in time, like click. This is exactly where we stood financially on December 31st. Okay, so let's get into the simple but super powerful logic that makes this whole snapshot actually hold together. I mean, this is an idea so fundamental, it's basically the law of gravity for all of accounting. And here it is. It's just common sense, right? Nothing just appears out of thin air. Every single thing a company owns, every truck, every computer, every patent, it had to come from somewhere. It was either bought with money the company borrowed, or it was bought with money the owners themselves put in. That's it. And that simple logic leads us straight to this: the golden rule, the accounting equation. What you own, your assets, has to equal the claims against those things. And those claims come from two places: lenders, which are liabilities, and owners, which is equity. This formula has to balance, always, to the penny, no exceptions. So just think of it this way. For every dollar of stuff on one side, there has to be a dollar of who paid for it on the other. It's not just some nerdy accounting rule, it's the fundamental truth of how a business is funded and built. The two sides have to tell the same story. So, with that in mind, let's zoom in on that first side of the equation. Let's take a closer look at what a company actually owns. What kind of stuff are we talking about when we say assets? Well, we basically split assets into two big buckets based on something called liquidity, which, is just a fancy way of asking, how quickly could we turn this into cold, hard cash? On one side, you've got things you can spend tomorrow. On the other, you've got things like a giant factory, not so easy to sell overnight. First up, we've got the current assets. You can think of these as the lifeblood of the business, the stuff that keeps the day-to-day operations humming along. We're talking about the cash in the bank, of course, but also the money your customers still owe you and all the products sitting in the warehouse just waiting to be sold. And then you have the non-current assets. These are the heavy hitters, the big-ticket items built to last, like buildings, machinery, and vehicles. But here's a really key detail. These things wear out. They lose value over time. So we have to account for that, and we do it with a little something called accumulated depreciation. Okay, so we've seen everything the company has in its picture. Now it's time to flip that photo over and look at the back. Where did the money come from to get all those assets? Who has a claim on all that stuff we just saw? First, you've got the short-term claims, or what we call current liabilities. These are the bills that are due soon, usually within a year. Think about things like paying your suppliers for raw materials, covering this month's payroll, and making the next payment on that big bank loan. And then, of course, you've got the long-term liabilities. These are the bigger debts that the company has a little more breathing room to pay off. Things like corporate bonds that might not be due for 10 years, or the long-term promises it's made to fund its employees' pension plans down the road. So, after everyone else gets paid, after every lender, both short-term and long-term, has been made whole, whatever is left over, that belongs to the owners. That's their stake in the company, their piece of the pie. That's equity. So where does this equity actually come from? Well, it's usually a mix of a few key things. The money the owners first put in to buy stock, and then, this is the big one, retained earnings. That's like the company's treasure chest. It's all the profits the company has ever made over its entire lifetime and decided to keep and reinvest back into the business. All right, now that we've seen both sides of the photo, it is time for a pretty important reality check. Because while the balance sheet is incredibly powerful, let's be real, it does not tell the whole story. Some of a company's biggest strengths are completely invisible on this document. Here's a huge one. Most assets are listed at what the company paid for them ages ago, their historical cost. So just imagine a company bought a plot of land in downtown Manhattan back in 1950. What does the balance sheet say it's worth? Whatever they paid for it in 1950. What's it actually worth today? An absolute fortune. You can see how this can seriously understate a company's real value.
And what's even crazier is that some of a company's most valuable assets don't show up on the balance sheet at all. I'm serious. Think about it. Where is the line item for a world-famous brand like Coca-Cola? Or a fiercely loyal customer base? Or a team of brilliant, genius engineers? They're not on there, but they are worth billions.
Now, accounting might seem like it's all about following the rules, but every good system has its exceptions, right? So what about the rebels, the accounts that kind of break the normal patterns we've just been talking about? Well, they're called contra accounts, and they basically work in reverse. Remember that accumulated depreciation we mentioned? It sits over on the asset side of the balance sheet, but its whole job is actually to subtract value from the other assets. It's a bit weird, yeah, but it's absolutely essential to give us an accurate picture of what those assets are really worth today. Okay, one last pro tip to keep in your back pocket. Just remember, the balance sheet is permanent. Its numbers roll over from year to year, building up over the entire life of the company. That's totally different from something like revenue or expenses, which we call temporary accounts, because they get wiped clean and reset to zero at the start of every new year. And that leaves us with a really fascinating question, doesn't it? We know this snapshot is incomplete. We know it often misses huge sources of value. So the real challenge for any smart investor or analyst is to figure out, how do we measure what's missing? How do we see what's really there beyond the numbers on the page?